Hi, I'd like to talk to you about an excess burden of an excise tax using a demand curve in this case. And I drew the formula, DWL, right here, stands for dead weight loss. Or I could also put excess burden. But basically we're looking at the welfare cost, dead weight loss, excess burden. Isn't it interesting they have three different ways or more probably of saying this? So what we have is it's going to be an area of a triangle. Let's draw this. Here's our equation. One half, it's area of it's a triangle, so one half base times height. So the height is going to be our price. We've got quantity, our tax. Well, what we have is this is a compensated elasticity, this is a price, quantity, and this is the tax squared. And so these terms deal with our one half base times height. Quantity has to do with base, price has to do with height. Obviously, also the compensated elasticity has to do with that also, and so does our tax. So actually, let's draw this a little better. Get out my trusty pen. So I'm going to draw a downward sloping demand curve. That's a nice straight line, doesn't it? Because we're going to do a triangle up here, perfectly straight. Okay, give or take. I'm going to draw a perfectly horizontal supply curve before the tax. I'm going to assume the price before the tax is equal to $10. Quantity I'm going to assume is 10,000. I'm going to assume my elasticity, my demand elasticity in this case, is equal to 1. And what else do we need? Tax. I'm going to assume my tax is equal to, let's make the tax equal to 20%, 0.2. So there's 0.2. So we can take the $10, it's the before tax price. I'm going to take the 10,000 and put it right there. There's our quantity. We now put on the tax, supply plus the tax. Well, with a 20% tax, what should that do? That should raise our price 20% more than $10. Well, 20% of $10 is $2. $10 plus $2 is what, $12? Or we could just notice what we're doing here is we're taking 1 plus the tax times the price, which is equal to 1 plus 0.2 times the $10, and that's equal to, I calculate, $12. Hopefully I'm right. So $12 goes up here. Okay, now that's 10,000. We don't have a number right here, but we do know the elasticity is equal to 1. And we know the elasticity is equal to percentage change in quantity over the percentage. That's supposed to be a triangle. Stands for change, so percentage change in price. And this is equal to 1. And we know the percentage change in price is equal to, well, it's the tax is raising our price by 20%, right? So 0.2 times 1 will give us what's up top here. So the percentage change in quantity is going to be 20%. Well, 20% reduction in this case, I'll take the absolute value. It's really a negative 1 because you raise the price, people buy less. They don't buy more at higher prices. And so unless the demand curve shifted, in this case, we're just raising the supply curve up by the amount of the tax. T for tax right there. Well, 20%, reducing 10,000 by 20% means we take 10,000 minus 0.2 times 10,000. And that's pretty close to 8,000. So I'm going to put 8,000 right here. Okay, we have our 8,000, we have our 10,000. This area up here, the $2 times 8,000. But let's do some different colors. This area is going to be our tax revenue right here. Actually, where's my green? So this area right here is going to be my tax revenue. And this Area down here is, let's put this as, I'm going to put it as blue. This is the revenue. The 10 times the 8,000 is our revenue. This triangle right here, I'm going to call our original point A. This is going to be B. Let's say this point is D right here. So area BAD is equal to our deadweight loss. Let's make that look a little bit better here, which is equal to 1/2 times the elasticity of 1 times the price of 10 times 10,000 times 0.2. That's not very pretty. .2 squared. And when I multiplied all that out in all those squared terms, I calculated, actually, what did I calculate? Well, I guess I'll have to do it again, because I don't see my calculation. I found it. It is, you probably did it faster than I did, of course. I found $2,000. So this area right here, this triangle BAD, is $2,000. This rectangle, vertical distance, base times height, base is 8,000 times 2, is what, 16,000? So let's do it in green. Tax is equal to 2 times 8. I'm going to put 8K so I don't have to put as many zeros. K standing for 1,000 is equal to 16,000? If I got it right. And then we have, let's see, what, 10? So revenue, let's do it in blue. So our revenue is equal to 10 right there. The height is 10 times the base is 8K. 8 times 10 is what, 80,000. Remember, K's in thousands. $80,000 for this revenue. And so, quick summary. Here's our equation. 1/2 times the elasticity, demand elasticity times price times quantity times tax squared. We set a price of $10, quantity of 10,000, elasticity equal to 1, tax is equal to 0.2. Where did we get those? We made them up. So on quizzes, what I often do is change the numbers. And we also saw that 1 plus 0.2, 20% higher than the original price is, price is 10, 1.2 times 10 is $12. So I put $12 over here. We then had to find out, this is 10,000, we need to figure out with elasticity of 1 and a change in price of 20% higher, we need to find this point right here. 10,000 minus 0.2 times 10,000 is very close to 8,000 right there. We put all these numbers in for this, and we ended up with 2,000. We cannot tax 10,000 because it's not being produced anymore. We can only tax the 8,000 that's actually being produced and sold. And so we have $2 per unit, roughly, times the 8,000, gives us our tax revenue. And we also have the revenue down here, 10 times 8,000. Thank you. Hope you enjoyed this wonderful world of taxes.